Good afternoon, everyone. Welcome to yet another webinar, and apologies for the technical hitches that I'm currently experiencing. I would love to request you guys to just bear with me for a minute. Thank you. Okay. Once again, apologies for the technical hitches, but now we are ready to start. So I'm going to share my screen very quickly. Okay. There we go. So as we start with our topic today of looking at the most traded currency pairs, before we begin, I want you guys to take a few moments and look at this pie chart that you see in front of you. So this is according to this data is basically according to the Bank of International Settlements, basically the bank of central bankers. So these are the most traded currency pairs. And as you can see, we have the euro dollar, 28% in terms of volume in a day relative to the other currency pairs. The euro dollar being the most liquid and highly traded, followed by the dollar yen, pound sterling, and Aussie dollar. So those are the currency pairs that we are going to focus on today and that we are going to talk about today. So very important to understand as you start on your currency trading journey, or investment lesson and learning basically how to profit from the currency markets. This is a must. You must be able to understand how these particular currencies trade, how they move, depending on how liquid they are, and what basically makes them tick. So very important to have a very firm grasp of that before you even start looking into other aspects of trading. Now, having said that, I'm gonna go straight to the presentation. So where is the presentation? So I'm gonna go straight to the document here. So now let's start. So forgot to put the disclaimer, but guys, trading carries a very high degree of risk, and you should only trade or invest money that you are willing to lose. So basically here that has to do with, typically like any other business, you would apportion part of your savings in order to start a business. Same thing with trading. Trading is a business. So you basically apply the same rules to it. So it is very important to have a baseline of currency behavior so that you are in a better position to anticipate, interpret, and react to market developments. Very, very important before you even go to things to do with charts and then tools and technical indicators and all that. Very, very important. So you can see I have highlighted anticipate, interpret, and react. So speculation is nothing more than anticipating, as it was well said by the famous trader Jesse Livermore. So understanding what makes these currency pairs tick and the behavior of these particular currency pairs will enable you to, number one, anticipate. Okay, come up with a very logic framework as to why you want to trade a particular currency pair and anticipate whether that particular framework will play out. And then the other thing, interpret. So basically interpreting the data that has to do with that particular currency pair. So after you anticipate, you interpret the incoming data to see whether it fits what you are anticipating. And finally, you react to market developments which might possibly be in alignment with what you had anticipated, or if the market data that was coming in is not in alignment with what you are anticipating, you will also know how to react accordingly. Very, very important to understand those three things. So I'm going to go ahead and proceed also with this quote. Speculation is nothing more than anticipating coming movements. In order to anticipate correctly, one must have a definite basis for that anticipation, what I was calling a framework simply. And you have to be careful because people are often not predictable. They are full of emotion, because at the end of the day, the market participants are human beings like you and me, and human beings have various ways of making their decisions. And so in your decision-making process, in formulating your framework, first things first, as I said earlier, you have to understand liquidity. Which currency pairs are basically liquid, which currency pairs will suit various trading strategies that you might think of coming up with, which currency pairs basically suit a particular scenario that you are trying to build on now that framework that you have. So Euro USD being the first actively traded pair in the world, and that is in the world of Forex trading. And every major desk has at least one euro-dollar trader to deal with the volume of this currency pair. So why is it the largest traded currency pair in terms of volume? It fights the US dollar against the single currency of the Eurozone, which is obviously the euro. Now, in 1999, by midnight January, all these other currencies which were used in the euro area no longer ceased to exist. They were basically suspended, and Europe basically had a common monetary system. So the Deutsche Mark, Italian lira, French franc, and the other 9 European currencies no longer ceased to exist, and they decided to use the euro. So you can imagine all those countries which are basically found in the euro area: Austria, Belgium, Cyprus, Estonia, Finland, etc., Germany, France. Germany being the country, the largest economy in that area, followed by France, and all those particular nations. So all of them transact in the euro. So that makes the euro very, very liquid in terms of trading volumes. Now, the euro USD is inversely correlated, meaning when the euro basically appreciates, the dollar depreciates. Okay, not on an overall basis, but trading this particular currency pair. Basically, that is how currency pairs trade. They trade in pairs. When one appreciates, the other one, when one is bid, the other one is offered. Now, the thing with the euro and why it is really loved by a lot of traders, it is because it has very narrow trading spreads. The liquidity makes the spreads quite narrow. So what is the spread? That is the difference between the buying price and the selling price, and it is something that will factor in your trading cost. So traders, especially short-term traders, like going after the euro or trading the euro. So liquidity with the Euro USD, it's based on a variety of fundamental sources. Number one being global trade and asset allocation, central bank credibility, enhanced status of the euro as a reserve currency. So as mentioned earlier, the euro being the largest economic bloc after the United States. And in terms of credibility, central bank credibility, the currency basically gained credibility in 2010 during the Eurozone debt crisis, which was known as the sovereign debt crisis, how the ECB basically helped navigate that crisis. For those of you who can remember one of the first countries to go belly up in terms of not being able to pay its debt was Greece. Well, it was quite a tough time in Europe, but the ECB made sure that the situation was kept in check. Even though there was a contagion throughout Europe, Europe managed to recover out of it thanks to the guidance of the central bank. So the central bank here meaning the European Central Bank. So it made the euro even more credible. At that particular period in time, there were a lot of talks going on and rumors going on, and people basically wondering, that is the Europeans wondering, is the Eurozone project going to be a success or a failure because of that sovereign debt crisis? But the ECB intervened in time, and that basically increased confidence in the euro thanks to that credibility, thanks to how the ECB worked. Enhanced status as a reserve currency. Countries around the world, they hold, besides from holding the dollar and having dollar reserves, gold reserves, they also have euro reserves. The euro, remember, it's a very large trading bloc. Many countries around the world want to trade with Europe, and hence it will be better for them and much more cheaper for them to have the euro in their reserves. So let us look at the sensitive data reports that tend to have an impact or an effect on the euro. So it's important to note, first of all, the largest countries in the Eurozone being Germany and France. So all data reports, economic releases that come from those two particular nations will tend to have an impact on the euro relative to other Eurozone countries. And you can see, as I stated, economic reports from these countries have a significant effect on the euro relative to other European countries or Eurozone countries. Why? Reason being they have the largest economies in that particular region. And the European Central Bank interest rate decision, very important to keep track of those interest rate decisions, like what basically happened yesterday. So this is one of the things that will have an effect or an impact on the euro. So now this is when the ECB president explains the ECB's thinking and offers guidance on the future course of interest rates. And you can see I have highlighted ECB president explaining what the bank is thinking and offers guidance. By guidance, basically meaning what the central bankers think is the future course, or might be probably the future course of the Eurozone area. For example, yesterday, so very, very quickly, I'm gonna let us have a look at what happened yesterday in terms of the release, that is Christine Lagarde's speech, interest rate or monetary policy press statement that happened yesterday, and what kind of guidance the market got and how the euro basically reacted. So this is the ECB presser, so I'm just gonna open it very quickly. Bear with me, guys. So guys, it's very, very important to understand or have a clue of what is happening or what central bankers think, so that you can be able to increase your chances of forecasting the direction of a particular currency, that is in terms of its strength and weakness. So I'm not going to go through the whole entire report, but just a few notes that I made here. Expectations of a rebound as vaccination campaigns can continue. The president, that is Christine Lagarde, that is basically the ECB committee, noted increased inflation at the same time. Underlying price pressures remain subdued in the context of significant economic slack and still demand. So to sum up, basically the economic analysis of the ECB yesterday and the situation at hand, sum up, check of the outcome of the economic analysis with the signals coming from monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and robust convergence of inflation levels that are below but close to 2%. So what does that basically mean? So yesterday, what this basically means is that the ECB was not going to take any further measures in terms of increasing their bond purchases or cutting interest rates, that is the cost of borrowing. And now, although the president was clear on that, she was also very, very optimistic. And you can see I have underlined some of that optimism. Vaccination campaigns, and the envisaged gradual relaxation of containment measures. All of those things, inflation having picked up, all of those things sending positive vibes in, positive vibes, which basically impacted the euro positively, and also thanks to the weakening of the dollar. And what simply transpired yesterday, we saw basically the euro gradually maintaining its support above the 120 handle, as you can see here. And breaking above it, first of all, that is a couple of days, then into the announcement, pulling back, trading at 120, and then today, moving up, targeting 121. Okay, guys, stay with me here. There is a reason as to why I'm mentioning all these things to do with the euro. And today, as of today, if we look at today, so I'm trying to just locate today's data very quickly. PMIs came out positively. Remember yesterday, as I said, Christine Lagarde was very confident that the euro area is heading in the right direction so far. And her having said that, if we look at all the PMI data that was coming out of Europe today, most of it, basically, you have the euro area manufacturing PMI and services PMI, all of them up. Germany's also flash manufacturing PMI all the way up. So all of this data is in alignment with what the European Central Bank is anticipating, and basically anticipating next quarter, seeing growth coming in. And so the market is basically trying to price that in, positive PMI data coming out, and hence that added more fuel to that euro advance. Very, very important to understand things within that particular macro context in order for you to be able to forecast much more with much more solid, concrete reasons as to why that particular currency pair is going to appreciate. Now, going back to our presentation here, my presentation here, that was the guidance that was being offered on the future cost of interest rates. So if you read yesterday's press release by the ECB, you will definitely see that guidance coming in. The data also that has been coming in is also confirming the same thing. Number two, speeches by the officials, like yesterday's speeches, will also tend to impact the euro. Then we have consumer price index and CPI, all measures of inflation. Very important to keep track on those measures of inflation, because eventually they'll determine interest rates, that is the cost of credit. And currencies basically like a situation where interest rates are a bit high when the cost of credit is up. Why? Because that increases the chance of a rate hike. And number four, the EU Commission Economic Sector Confidence Indicators, consumer and investor sentiment surveys. Very important to keep an eye on them, like the Info survey, ZEW survey, market sentiment surveys. industrial production, retail sales, unemployment rate, sovereign debt sales. So important to take note of all these if you want to have positions or if you want to have a view as to how the euro is going to trade. Very, very important to track all this data all these data releases, economic data releases, in context with the guidance on the future that is being offered by the ECB Central Council meetings. So what are the trading traits or behaviors of the euro? Okay, I'm way ahead of myself here. Okay, there we go. So what are the trading behavioral traits of the euro? Normal conditions, the euro tends to trade tick by tick, opposed to other currency pairs because of that liquidity aspect of it that I was talking about. So less liquid pairs typically fluctuate, their fluctuations are usually more, in terms of volatility, are usually volatile in terms of their fluctuation, and their spreads are usually wide. So currencies which have wide spreads due to lack of ample liquidity relative to the Euro USD, they tend to have large swings. The Euro might not have large swings as one might expect, but trading it short term can be a very, very good approach when it comes to trading the euro dollar, because you'll be in and out. You can be in and out in a matter of minutes or seconds, whatever way you would want to trade it, depending on your assessment of all these factors that influence the euro. That is, you can be able to get in and out very, very, very quickly because of that ample liquidity and the low cost of trading the euro. So moving on, dollar yen, the east meets the west. Basically, the dollar yen is considered as a safe haven, and which means it tends to rally when there is panic in the market. So the question is why? Why is the dollar yen considered to be a safe haven? Or let's say the Japanese yen, why is it considered to be a safe haven currency? For a very long time, Japan's interest rates have basically been at negative levels. Let's have a very quick snap look at that. The interest rates, the Japanese interest rates for quite a period of time. So bear with me also on this. You have to. So I think I have it here. Okay, good. There we go. So if you look at the interest rates for Japan, you can see we have a negative interest rates, negative 0.1. Interest rates for Euro area, for example, I think it's at 0%, not in the negative territory. So anyway, how does that basically relate to the Japanese yen being a safe haven currency? Safe haven currency, it's a safe haven currency in the context that it is a funding currency. So what fund managers basically typically do, they buy the Japanese yen because it is cheaper. It's cheaper to have the Japanese yen. You see, its cost is relatively cheap because the interest rates are basically in the negative territory, and then uses it to buy a higher yielding currency. For example, a higher yielding currency in this particular case or situation means a currency that has a higher interest rate. So that is a higher yielding currency or a high beta currency. So using the Japanese yen as a funding currency in order to purchase that particular currency that has a high high interest rates. I mean, a higher interest rate, that means a higher yield. So that is the reason as to why most fund managers usually typically prefer using the yen as a safe haven, so that it can be able to give them the opportunity to buy those high yielding currencies, also known as beta currencies, high beta currencies, BETA. Okay. Okay. Going back here, so we have established why it is known as a currency pair. So why it is known as a safe haven currency pair. So another thing that you need to know, the dollar yen is heavily influenced by US interest rates. In fact, the main driver for dollar yen is the movement of US interest rates, and that is because massive amounts of government debt held by the Japanese government because of massive debt held by the Japanese government and investors. So Japanese government and investors are the biggest, one of the largest bond holders of US, basically holders of US credit. So when rates fall, that is the cost of credit. When it goes down, bonds go up, increasing the dollar value of Japan's debt holdings. And to offset this, to offset their larger dollar long currency exposure, the managers will tend to sell more dollars. In fact, if you look at a bond yield chart, that is the 10-year, for example, bond yield chart, and you look at the dollar yen, they sort of move in concert, and sometimes one can be used to signal a move. That is the bond yield chart can be used, the 10-year bond yield chart can be used to signal a move in dollar yen. Very, very, very important to take note of that. And let's just go and again have a look at a dollar yen, and just have a look at that correlation, see whether we can be able to see it very quickly. It's important to also understand some of those intermarket relationships. So bear with me here, guys. I'm going to divide this chart like that. So have the 10-year yield here. So that's the bond yield. And the dollar yen. Okay, there we go. That's the daily chart. So you can see how the bond yield basically moves. It basically the bond yield, the move of the 10-year, the price you basically quote it. It's basically quoted in basis points, and you can see if we have a very strong uptrend with a 10-year, dollar yen also basically trends upwards very, very strongly. And sometimes we start having a trend, an upward trend, for example, that means the bond yield basically starts charging upwards. And you can see there is a slight delay here on that particular day, and even going forward, sometimes there's usually a very slight delay. But the bond yield, that is the bond market, the money market, can signal a potential future move when it comes to the dollar yen as a currency. Topped out last week. As you can see here, topped out last week. That is the bond yield, topped out last week. The euro, the dollar yen had not yet topped out, but later on it also topped out and just came crashing downwards up to 107 level, thereabouts. So it can be used to signal that move. So the correlation between the United States 10-year bond yield and the dollar yen is quite strong. Okay, so let's go back to our slide. And so it's also important to know that the Ministry of Finance is heavily involved in the forex market. That is the Japanese Ministry of Finance. Why? As you can see, Japan remains a heavily export-oriented economy, accounting for more than 40% of overall economic activity. So the yen is a critical policy lever for the Ministry of Finance in Japan, and also for the Bank of Japan. They wouldn't want to see the yen becoming very, very strong. That will tend to affect the price of their exports. I mean, and we know Japan is a very big player in the export market, especially in the motor vehicle sector. So they won't shy off to intervene in that particular market. So the asset managers also in Japan tend to move together. And you have seen that the yield, the interest rates in Japan, it's at negative territory. So most Japanese savers, okay, Japanese, they're known to be better savers than Americans. 15% savings rate compared to US, which is 5%. So managers control trillions of dollars in assets, bulk of which is invested in the fixed income market, and fixed income market in basically other jurisdictions. And we mentioned earlier, like in the United States. So they're always chasing for the best yielding returns. So most savers don't like investing their money. Maybe most probably pension fund managers and the sort don't like investing their monies in the fixed income market in Japan. So they will tend to go offshore. And so they tend to move together, pursue similar investment strategies, and that results in tremendous asset flows hitting the market over a relatively short period of time, impacting the price of the dollar yen. So very important to follow that bond market in order to have a grasp of how dollar yen moves, and in order to come up with concrete forecasts on dollar yen. In order to add also an edge to your forecast, very important to also regard the Japanese data reports or economic releases that tend to have an impact on the yen. So we have monetary policy decisions, of course, monthly economic assessments, and monetary policy. So very important to read those monetary policy statements as we have seen earlier, for example, with the ECB, trying to see what kind of guidance the bank is trying to give the market or to lay out there. And you can be able to get hints as to whether the BOJ, that is the Bank of Japan, will be involved in intervening when they see the yen appreciating faster than they would want it to. So Japan is known to do that a lot, and they're not shy of doing it. So we have industrial production, important. Machine orders, also very, very important. Remember, 40% of the country's exports basically are in the industrial, involve industrial products and also machine orders. And as I said earlier, they're very big players in the motor industry all over globally. So retail trade, of course, very important to monitor retail trade. It's important in helping one understand the consumers, Japanese consumers, what is basically their sentiment when it comes to spending. So bank lending, very important. Domestic corporate goods price index, okay, national CPI and Tokyo area CPI, very important inflation measures. And all industry activity index and tertiary industry. You can see with Japan, the economic releases to really pay attention to involve a lot of releases that have to do with manufacturing, with the manufacturing sector, that is. Okay, moving on. As I said earlier, so now price action behavior for the Japanese yen. Let's look at how does the Japanese yen behave, and you can see it seems to have an on and off switch, and it can spend hours and days in narrow ranges and then march off steadily to a new price level. So what does that mean? That means with the dollar yen, breakouts tend to be much powerful, very, very powerful. Very important to watch out those breakouts. And the reason for that, the main reason for that is that relationship between the yen and the bond market. That is the United States bond market, and specifically here, bond yields. Remember, the bond market is not only a major signal when it comes to assessing or analyzing dollar yen itself. No, also in telling what are investors' expectations as to future returns or yields or performance of the market. So when you look at bond yields are basically behaving well. By behaving well here, I mean basically heading higher. That is the 10-year. The market is really trying, that is the credit market is really trying to price in a situation whereby the future prospects of growth are good. So investors would expect higher yields in the future. And if it happens in the opposite fashion, that basically means that investors are very skeptical as to future investment prospects or future returns. Let me say future returns. So the dollar yen, since it follows this credit market very closely, it will tend to have that on and off switch, meaning when it comes to judging a risk sentiment, by simply looking at the dollar yen, you can be able to project risk sentiment as of now and into the future. in terms of economic growth, in terms of even stock market performance. Okay, number one, before saying all that, we're still on price action behavior for the dollar yen. It's prone to short-term trends followed by sideways consolidation, several hours to several days and those consolidations basically responding well to technical levels, that's levels of support and resistance of various price levels. So the levels are critical, that is technical levels critical to dollar yen, as I said earlier, tends to respect those particular levels. Now, price action is usually highly directional. And you can also see when you look at even the bond yield, the yield chart itself, it's usually very directional in terms of trend, in terms of movement. So for example, if I look at the 10-year, you can see for the monthly chart, the 10-year, as you can see, it usually tends to have quite nice trending swings, up, down, up, down, up, down. So that's even the monthly chart. Let us even switch the daily chart itself. So it tends to trend, tends to be very directional, as you can see. And so since dollar yen mimics this particular behavior most of the time, it also tends to behave in a similar manner. But remember, currencies, besides from dollar yen being affected by what is happening in the bond market, also those two countries, currency pair trading, or when you start looking at currency pairs, you are basically comparing two countries in terms of growth, inflation, and interest rates. So there are other factors that will tend to come in and affect the movement of that currency pair. Besides, the dollar is also affected by many other factors out there, including commodity prices. But majority of the time, it tends to move in a one-directional fashion, that is the dollar yen. Okay, moving on. The reversals, when it comes to ahead of myself again. Okay, price action behavior, yep. Now, again, spike, that is reversals, which basically spike very sharp 20 pip to 50 pip price movements in the opposite direction of the prior move from technical levels are relatively common. Obviously, it's because of reason number 2. And having said that, having noted that, so guys, that should be your homework. If you're looking at the dollar yen, try to see its behavior around those particular technical levels. Try to see its behavior in terms of momentum, in terms of trend, and how it moves. It's a visual exercise. You'll just have to do it. I'm not going to do it for the purposes of time, but I've pointed how you can go about it. So let's go to the cable, that is the British pound or the sterling. It's the largest national economy, third largest in Europe, that is after Germany and France. Upward of 2/3 of UK foreign trade is conducted with the European Union member states, at least prior to Brexit, but it is still the case, really. And well, this special pair, Euro versus the sterling, it's a very important trade-driven cross rate to also monitor. This is just a by the way. Now, important UK data points to also keep an eye on. And the good thing with the cable, it will tend to react sharply to economic reports, especially when the data is in the opposite direction of expectations, or as I've highlighted here, when the data is contrary to current monetary policy speculation. You have to ask yourself, why is it that every time I mention monetary policy, whether to do speculation or whatever it is, I highlight it in yellow? Because that's how you start building your framework when it comes to trading currencies. You have to understand what monetary policy stance is, even before you start focusing on other data releases in the course of the month, or in the course of the trading period or trading time horizon. Very important. So if data comes opposite in terms of expectations of MPC, that is monetary policy speculation, if let's say, for example, the bank is anticipating better retail sales number, better consumer confidence data coming, if it is pegging its monetary policy or its monetary policy review based on good inflation numbers that have currently been noted. And suddenly, okay, not suddenly, but unfortunately, the numbers come down. That is, the economic data releases, miss the targets, then the pound will tend to react very, very, in a very volatile fashion. So it's a very good currency to track as you also track data releases and as you also track expectations by the central bankers. So remember, as we started this, as I began this particular webinar, I said speculation is basically a matter of expectations, of looking at expectations and judging things from that angle of expectation. So question you should ought to ask yourself when you're beginning and when you're learning these things is, what does the central banker expect? What are they looking at? And what is the market saying? What is the market communicating? What is the data? Is the data in alignment with those expectations? That is the economic release data, or is it not in alignment with those expectations? And we are saying with the sterling, if the data is contrary to those expectations at a high degree, then the sterling will tend to really move aggressively. If the data is not contrary to the expectations, then also the British pound will tend to act accordingly. For example, we have been having a very good retail sales data coming in today. If you look at the last Bank of England Monetary Policy Committee meeting, they were a bit optimistic, looking at the data, moving forward, going ahead. And that means that if they were optimistic, all the data that is coming in to do with, that comes in and confirms that optimism, that will tend to make the pound move higher. So even if you are trading on an intraday basis, you're a short-term trader and all that, it's very, very important to have all those things in mind so that you can be able to know how to position yourself even when you're trading short-term. Very, very important. So, looking at the data reports, Monetary Policy Committee obviously discussed that extensively. Minutes, which are released 2 weeks after each MPC meeting. Very important to go through those minutes so that you can be able to gauge the sentiment of these particular central bankers, or let me just say the Bank of England at large. So retail sales and BRC retail sales monitor. Let's very quickly. One of the main releases today, we had retail sales data for sterling coming out. You can see retail sales month on month beating expectations of 1.5%, jumping to 5.4%. So this basically acts as a reinforcement of the central bank, as that is the Bank of England outlook on the state of the British economy going forward. And remember, another thing also I've forgotten to mention is that the UK is leading when it comes to vaccinations. I think it's the US, then the UK. Between the two, it's leading. Then coming in, this positive data coming in, then at the back of your head, because you have been a diligent trader and you have gone through all the monetary policy committee minutes and statements and all that, you know that anything positive that comes out will tend to confirm the expectations of the central bankers. And how has the pound basically reacted to that? That would be the question. After all, let's look at the sterling today. You can see the sterling traded at a low of 138.50. Yesterday bounced off that level quite aggressively. We have a massive double bottom here. As you can see, massive double bottom. For those guys who basically look at chart patterns, something of that sort, that is technical chart patterns and all that, they know this is a very good signal of a reversal. Price this level at 137 basically holding, price moving higher, coming back, pulling back up to 135 level and then bouncing back. Everything is optimistic about sterling, about the UK when it comes to handling the pandemic, optimistic. When it comes to data that is coming out, data to do with inflation, data to do with PMIs, data to do with retail sales today, all of it optimistic. So personally, I'm pretty bullish on that sterling. But remember this, that is not investment advice. Now, so very important to keep an eye on inflation gauges such as CPI, PPI, BOE monetary policy committee minutes, which are released after every 2 weeks or 2 times in a year. Then we have, finally, we have the consumer confidence survey also. Okay, so I think my time is almost over, but that is the last bit of it before we look at the Aussie. But again, very quickly, let's look at some data points that have to do with sterling. Go back to my browser. Apologies for this. Looks like a lot of work. So let's go back to the browser, and I think I had the United Kingdom somewhere here. That is United States. Let me just have the United Kingdom here. Look at those data points very quickly. So the United Kingdom. Oh, oops. Europe. United Kingdom. Why am I not getting what I'm looking for? Anyway, let me just United. Yep, there we go. So let us look at inflation data. Interest rate still at 0.1. Inflation rate month on month, 0.3. Relative to the previous point at 0.1, 0.1. Sorry, relative to the previous reading. So that's good. Unemployment rate is also, moving, but we see there was a slight decline. But with the current reopenings that are happening, I expect to see a higher figure than the previous figure. A lower figure, sorry, a lower figure. This is unemployment rate. Apologies for that. So you see it was 5, then it's moving down to 4.9. So quite positive. Inflation is also getting charged up. Overall inflation 0.4, and latest reading was 0.7. So it's really moving higher. So that bodes well for the sterling. It basically indicates that things are coming back to life. The economy is reviving. The vaccine program is really working, and the numbers coming out are quite good. So yeah, that's basically the data points that you would be really interested in. Interested in looking at. Now, price action behavior for the cable. We said it has a volatile behavior. And this will present it with a unique set of challenges, but also opportunities, because you can be able to have very short-term results in a very short period of time, and results can be significant. And by the way, those results can either be losses or profit. So if you are good in anticipating and waiting for the market to confirm whatever it is or whatever scenario that you anticipate to play out, then in a very relative short period of time, you can be able to scratch something significant out of the cable. So its movement is similar to Euro USD. Trades inversely with the same way Euro USD, Euro versus the dollar trades inversely. It's the same way pound sterling trades. So thing is, the difference between the two is because of the difference being liquidity between the two. So the spread for Euro USD usually tends to be much more thinner compared to the spread of pound sterling. So Sometimes if Euro USD sees, for example, a 60-point rally, that 60 pip rally, cable may see a 100-point rally, basically in the same direction. So this goes back to liquidity and generally lower level of market interest in the cable compared to Euro USD. So finally, let's look at the Australian dollar. The Australian dollar has overtaken other currencies like the dollar, other major currencies like dollar CAD and the dollar Swiss. Reason being, Australia's economy really weathered the 2008 financial crisis extremely well, number one, relative to the other countries. In fact, Australia was the only country that did not dive into or go into a recession. And it is often traded as a proxy for China, being the largest trading partner. China's largest, Australia's largest trading partner being China, and Australia also being a major player in the commodities space, China being a major consumer of commodities. So their relationship is very, very important. So how Aussie is doing really gives you a picture of how China is doing, or how China is doing will give you a clue as to how Aussie is doing. So it is also one of the major commodity producers. That is, so it can be very sensitive to changes in commodity prices. And the key Australian data reports to watch out for. Of course, the Reserve Bank of Australia interest rate decisions have really, really explained in detail how it's very important to follow all these things to do with interest rates by any bank out there. So RBA's, that is the Reserve Bank of Australia's monetary policy meetings, retail sales, obviously, housing prices. Also, these two are very important in understanding consumer sentiment. Are consumers willing to spend more? And in any economy, the more consumers spend, especially in consumer-driven economies, the more consumers spend, the more income other people make. And number 6, industrial manufacturing production, important, given that it is a big play in the commodity space. Employment data, obviously. And by the way, employment data applies across the board. Seems like I forgot to write that in my notes with the other pairs, but it applies across the board because one of the major functions of central bankers is basically, control prices, and also at the same time ensure that employment is at its maximum. Chinese data also, most particularly, particularly including manufacturing PMI, survey data, trade data, and interest rate changes in China. All those things tend to have quite an impact on the Australian dollar. And as a quick exercise, you can try to see when it comes to the Australian dollar and various commodities, you can try to see that relationship between commodities. I think I have something here with commodities. I hope it loads up because I can see we're really out of time here. So if you can be able to track commodities quite well, copper futures, for example, crude oil, that's basically energies, but also falls in that category, silver, and how they basically tend to behave. How they basically tend to signal the behavior of the dollar. When commodities are basically rallying, the dollar basically tries to tank. The dollar basically tanks or declines a little bit when commodities are rallying. And you can see also the 10-year itself starting to break below that 50-period moving average. You can see this is the dollar index, how it is basically trading below those two particular moving averages. So how will the Australian dollar behave in such a scenario, or how is the Australian dollar behaving? So let's just look at the Australian dollar here, the Aussie, and see, it can be either be the Aussie USD or also the Aussie yen. You can see long term, we're looking at things here long term. In order to see that intermarket relationship, you can see Aussie and something like copper futures tend to move together. And another thing about commodities tend to really trend nicely when they start trending. And that is also the price action behavior of the Aussie. It also tends to trend a lot. In fact, for most trend traders, it is usually a favorite pair to trade for them. So yeah, now having said all that, well, the next 5 minutes, let's try to use the next 5 minutes to answer some questions if they are there. So, well, I don't seem to see any questions here.
There's a question on the chat section from Simon.
Oh, chat. Okay. Okay, materials. Yes, I'll definitely email. I don't know which company Lawrence is talking about, but I'm assuming it's the broker. No, the broker can't do that. A broker is simply, simply links you to the market. Have you partnered with any organization for certification? That's a very good question. No, we have not partnered with any organization. I don't think so. And I don't think it's really necessary. But we are working with a regulated broker. I think that basically counts for this. I don't know, but I'm just looking for any market related question.
There was one in the Q&A section. Timothy Ngure. Oh. Hello, in which market does Q&A, the stated pairs usually move?
Does the stated pairs, which market?
I guess it's okay.
Yeah, he has clarified and meant in reference to Asia, London, or US markets. All markets, basically. Now, in terms of liquidity, when it comes to a currency pair like the sterling pound is usually not that liquid during the Asian and also the US trading session or market hours. It's usually not liquid during that particular time. But the rest, especially the Australian dollar, it's tradable at all other times, even including during the Asian. It's very active. Also during the US market session is also very active, because remember I said the Australian dollar is highly correlated to commodity markets, and those markets are heavily traded during the US market sessions, and also heavily traded during all those sessions. Basically, commodities are usually heavily traded. The Australian dollar is also a very good currency pair to monitor overall market sentiment during active trading hours. Very important, because it tends to also move in alignment with some of the stock market indices. It also tends to move in alignment with them. So Australian dollar applies across, entire times dollar yen too, given the fact that dollar yen also has a high correlation with bond market. Euro USD being the most liquid at all times. It's only the sterling pound that tends to be much more active during the European session, but not during the Asian and the US session. So if there is no any other questions, so I don't think there is any other questions. So thank you guys for attending this webinar, and homework. Let me give you guys some homework, but basically what it's going to give you much more confidence when it comes to trying to forecast the direction of currency pairs and how currency pairs will tend to trade. Make sure that you read the monetary policy statements, you understand them in detail, try to see what the central bankers are doing or thinking, basically. What are they thinking, what their expectations are, and how are those expectations in alignment with economic data releases. And as you do that, then you can be able to have a very good forecast and trade confidently with an extra edge. So thank you guys. have a good weekend, and happy trading out there.